Hey everyone, welcome back to Beyond the Bottom Line. I'm James Troy, an entrepreneur, accounting student, and your go-to guide for making sense of your business finances. Today, we're diving into one of the most important skills you can have as a small business owner or student entrepreneur, how to analyze financial statements. We're going to cover a range of techniques from vertical and horizontal analysis to common size financial statements, and we'll break down key financial ratios for liquidity, solvency, and profitability. Let's get right into it. Let's start with vertical analysis. Vertical analysis is a technique where every line item on your financial statement is expressed as a percentage of a base number. For example, on the income statement, you show every expense as a percentage of total revenue. On the balance sheet, total assets and total liabilities and shareholders' equity are each set to 100%. This method quickly highlights how much each expense contributes to your overall cost structure. It's particularly useful for spotting major expense drivers and comparing your business to industry benchmarks, even if your numbers aren't as large as those of bigger companies. Essentially, it turns a mountain of numbers into a clear, comparative picture of where your money is going. Let's look at an example. This is the income statement for Pete's Coffee Shop. If it looks familiar, it's because it's the income statement that we used in the last video, all about preparing and analyzing the cash flow statement. Throughout the accounting period, Pete's Coffee Shop brought in coffee sales revenue of $801,000. But after accounting for all of his incurred expenses, he was left with a net income of $97,000. We're going to use vertical analysis to understand how these numbers compare to others in the coffee shop industry. Okay, to compute the percentages of sales each line item represents, we divide the line item amount by the total sales of $801,000. So if we divide $280,000 by $801,000, then we know that cost of goods sold is 35% of total sales. If we continue this process down the rest of the items on the income statement, we can find out that gross profit is 65% of sales, operating expenses are 52% of sales, and our net profit margins are about 12%. But alone, these numbers do not mean anything. This could be really good or really bad, and it all depends on what you're comparing it to. So let's bring in the industry standards for brick and mortar coffee shops. Generally, coffee chains spend about 25 to 30% of their sales on cost of goods sold. This covers everything from coffee beans and milk to syrups and pastries. In other words, for every dollar that you bring in, around 25 to 30 cents goes towards the raw materials needed to create your products. With cost of goods sold in the 25 to 30% range, most coffee chains enjoy a gross margin of roughly 70 to 75%. This percentage represents the revenue left over after paying for the direct costs of producing your goods, and it's a key indicator of your product pricing and cost control. Operating expenses, which include labor, rent, utilities, marketing, and other overheads, typically come in around 50 to 60% of sales. These costs show how much you're spending to keep your business running day to day beyond just producing the goods. After subtracting all expenses, net income margins for a coffee chain usually fall between 5 and 10%. This bottom line tells you how efficiently your business is turning sales into profit. While larger, well-optimized chains might push towards the higher end of this range, smaller or less efficient operations might see margins at the lower end. Compared to the industry benchmark of 25 to 30%, the shop's cost of goods sold is slightly high but not extreme. This suggests there may be some inefficiencies in sourcing ingredients or waste inventory management. Next, let's look at our gross profit. Our gross profit of 65% is solid and aligns well with the industry norm, 65 to 75%. This tells us that the business has pricing power and a strong brand. Operating expenses being 52% of sales is very high compared to industry benchmarks, which typically range from 35 to 45%. This suggests that rent, wages, utilities, marketing, or other overhead costs are eating too much into profits. However, despite this, the business is still profitable above industry standards. Since 52% of revenue goes towards operating expenses, cost control should be the top priority. Here are a few things that you might consider doing if you are in this position as a business owner. 1. Labor costs. Are too many staff scheduled during slow hours? Can labor be optimized with better scheduling? Rent. If rent is a major factor, is the shop in a high-cost location that doesn't justify the expense? Would a smaller space or renegotiating rent be an option? Marketing. Is marketing spend yielding enough ROI? Could cheaper organic methods such as social media or referral programs be used instead? Utilities and supplies. Are there unnecessary expenses in day-to-day operations, such as excessive energy use or overpriced supplies? Now, while vertical analysis gives us a snapshot at a single point in time, you might also want to see how these figures change over the years. That brings us to our next technique. Horizontal analysis looks at your financial data over multiple periods. Instead of percentages of a base amount, you're comparing actual dollar changes and percentage growth or decline from one period to the next. This approach is perfect for spotting trends. Is your revenue growing consistently? Are your expenses creeping up faster than your income? Horizontal analysis helps you understand the direction your business is heading by highlighting increases, decreases, and any anomalies that might need attention. It's like reading the story of your business through its financial performance over time. Let's prepare a horizontal analysis calculating the change in amount and year-over-year variance in each account for the comparative balance sheet for Pete's Coffee Shop. Okay, here is the comparative balance sheet for Pete's Coffee Shop for the years ended 2023 and 2024. Just like the income statement, I borrowed them from the last video where we prepared a statement of cash flows. We can see that throughout the period, Pete's Coffee Shop increased its assets and liabilities, which is generally a good sign. However, we want to do a deep dive and figure out by how much and by what percent each account grew. This will give us insight into which accounts have been growing or losing value and why, which will inform decisions going forward. Calculating the changes in value is easy. We just subtract the current year's account value from the previous year's value. For an example, our cash account increased by $96,000 throughout the period, our accounts receivable increased by $5,000, and our inventory increased by $10,000. Let's continue this for each account. Great. Now we need a good way to compare the changes in the amount of each account to each other. Since every account had different starting and ending values, calculating the variance or percent change will allow us to confidently compare. To do this, we will take the change in amount divided by the 2023 ending balance and multiply that by 100 to turn it into a percentage. We use the 2023 balance since that's the year that we want to compare it with. If we apply this formula to the cash account, we get a variance of 192%, 92,000 divided by 50,000 times 100. We do accounts receivable in the same way. 5,000 divided by 35,000 times 100 gets us a variance of about 14%. I'm going to fill in the rest of the variance amounts now. Awesome. So now the question is, what can we take away from these numbers? Well, here are the three biggest things that jumped out at me when I was looking at these numbers. 1, our cash surged by 192%, a $96,000 increase. 2, owner's equity rose by 79%, $71,000 increase. And 3, our liabilities increased. Short-term and long-term loans were up 20 to 25%. Here's how this information might affect your future decisions as a manager of the business. The increased cash position signals strong liquidity, but instead, reinvesting excess cash into money-generating assets could be a strong move going forward. If we focus on owner's equity, this increased because of an addition to owner's capital during the period, and because Pete's Coffee Shop is running a profitable operation. He's in a strong position going into next year and should continue to double down on what has been working thus far. Finally, in terms of short and long-term loan management, ensuring that increased borrowing is generating a return on investment higher than the cost of debt, and prioritizing paying down short-term loans, $30,000 up 20% first, as they likely carry higher interest rates than long-term debt, would be smart. Now, let's move into key financial ratios for liquidity, solvency, and profitability. This is yet another tool that managers use all the time to guide future decision making and identify weak spots in the business that need to be addressed. Liquidity ratios are all about assessing your business's ability to cover its short-term obligations. First up is working capital, which is simply your current assets minus your current liabilities. A positive working capital is essential because it indicates that you have enough short-term resources to keep your operations running smoothly. If this number is negative, it means that the company is relying on its suppliers and creditors to finance its operations rather than using its own cash reserves. A business with this issue is likely to go bankrupt if something is not done about it. Pete's Coffee Shop has a working capital of $181,000, which is very strong. Next, we have our current ratio, calculated as current assets divided by current liabilities. This ratio gives you a snapshot of whether your current assets can cover your immediate obligations. For that reason, a healthy current ratio is anything over 1. Since Pete's Coffee Shop has a current assets of $256,000 and current liabilities of $75,000, it is a current ratio of 3.4. Well above the benchmark of 1. But sometimes inventory isn't as liquid as cash or receivables, meaning that it takes longer to convert into cash. That's where the quick ratio comes in. It excludes inventory and prepaid expenses, offering a stricter test of liquidity. Because it excludes these two current assets, it is always lower than the current ratio. Pete's Coffee Shop has a quick assets of $186,000, translating to a quick ratio of 2.5. This is a very strong cash position, and the owner should consider investment of some of this excess. In addition to these, turnover ratios can shed further light on efficiency. The accounts receivable turnover tells you how many times you collect your receivables during a period, while the inventory turnover indicates how quickly you're selling and replenishing your stock. Here is how we can calculate each. Accounts receivable turnover is credit sales divided by average accounts receivable. We can find our average accounts receivable by taking our ending balance plus the beginning balance and dividing that by 2. Similarly, to find inventory turnover, we divide our cost of goods sold by our average inventory, which is the ending inventory, plus our beginning inventory divided by 2. It can also be helpful to convert these amounts into average days, like average days to collect receivables or average days to sell inventory. To do this, just take 365 divided by the accounts receivable turnover or the inventory turnover. This provides tangible measures of your operational efficiency, showing you just how effectively you're managing cash flow in day-to-day business. Pete's Coffee Shop has an accounts receivable turnover of 21.36 and a days accounts receivable of 17.1, meaning that on average it takes the company 17.1 days to collect payments from its customers. This is competitive with industry norms of 20 to 30 turnover and about 12 to 18 days receivables. Meanwhile, Pete's Coffee Shop's inventory turnover is at about 4.31, with days inventory of 84.7, meaning it takes them about 85 days to sell and restock all of their inventory. This is quite a bit higher than typical fast-moving coffee chains that have days inventory between 30 and 60 days. This is likely due to overstocking or slow-moving inventory that's tying up cash. In order to fix this, improve demand forecasting, adjust ordering, or introduce promotions to reduce excess stock. Now, let's talk about solvency ratios. While liquidity ratios focus on the short term, solvency ratios help you understand your business's long-term financial stability. The debt to equity ratio compares your total debt to your equity, giving you insight into how much of your business is financed by borrowing versus your own funds. A lower ratio generally signals a healthier balance and less financial risk. Pete's Coffee Shop has liabilities of $175,000 and equity of $161,000, giving them a debt to equity ratio of 1.1. This is slightly higher than industry benchmarks, 0.5 to 1.0 for coffee chains like Starbucks. To get this down, consider using retained earnings for expansion instead of additional borrowing to keep leverage under control. Similarly, the debt to assets ratio shows what proportion of your assets is financed by debt. Since Pete's Coffee Shop has debt of $175,000 and assets of $336,000, it is a debt to assets ratio of 0.5. This means that half of the business assets are financed by debt, which is aligned with the industry norms that are between 0.4 and 0.6. These ratios are essential for assessing whether your business is over-leveraged or well-positioned to weather economic downturns. Finally, let's talk about profitability ratios, metrics that reveal how well your business turns revenue into profit. For small business owners, key ratios include the net profit margin, which measures net income as a percentage of revenue, and return on assets, which indicates how efficiently your assets are used to generate profit. While ratios like retained earnings, like earnings per share, and price to earnings ratios are often more relevant for public companies, understanding your net profit margin and return on assets can help you assess operational efficiency and make strategic improvements. These ratios ultimately tell you whether your business isn't just surviving, but truly thriving. Let's talk about how to calculate each. Net profit margin is a percentage of total revenue that net income makes up. We actually already calculated this number to be 12% when we were doing the vertical analysis of the income statement. Return on assets is calculated by taking the net income and dividing it by the total average assets. Just like before, we find out total average assets, we add the ending assets balance to the beginning assets balance for the period and then divide that by 2. Since Pete's Coffee Shop had a net income of $97,000 and average total assets of $285,500, they have a return on assets of 0.34. This number is substantially higher than the industry standard between 15 and 20%. This signifies strong asset efficiency, meaning Pete's Coffee Shop is generating high profits relative to its assets. This could indicate effective cost management, strong sales, or high margin products. So there you have it, a comprehensive walkthrough on how to analyze financial statements. We started with vertical and horizontal analysis and then explored the key liquidity, solvency, and profitability ratios that help you see your business's full financial picture. By understanding and applying these techniques, you'll be better equipped to spot trends, manage risks, and steer your business towards long-term success. If you have any questions or need further clarification on any of these concepts, drop a comment below. Thanks for watching, and I'll see you in the next video.